We've had a problem with tech in the past, but hopefully not this time. So welcome to the event. It's going to be slightly different this time. There's a lot more to go through, and I'm going to share quite a lot of the sites. So just let me know that you're on, that you can see and hear me, and indeed that you can, most importantly, you can hear me. So as I said, welcome one and all. We've had numerous issues with, hi Themis, I hope you can hear me. And good morning, Auckland, good, it's all good, I'm glad. Right, I'm going to share the screen with you. So delighted you could all be here. And like I said, we've got quite a lot to go on. So thumbs up and let's share the screen. And like I said, I'm going to share, there's quite a lot to get through, as there always is with these. So delighted it's loud and clear. Now here we go. And I'm going to start, as you know, normally I start with some of the political stuff. Now remember, this isn't individual financial advice because I'm not speaking to you individually, I'm speaking to you collectively, and it's for educational purposes only. I'm just going to show you how we've been doing on some of the models we've created. Now, models are very much created for individuals based on their own particular, and I'll share this with you in a second, particular drawdowns and requirements. And before I get into this, one of the things I want to go into is where we see the world at the moment. Okay, so were I to show you what's going on at the moment, Intel, more investment from Apple. Whilst the president has acquired a stake for the US government in Intel and doing all these deals, we tend not to chase narratives and stories. That's not to say Intel might not be a good punt or speculation and whatever, but I just wanted to set some context on how we do things. We tend not to look for those narratives and stories, tempting though they are. Now, if you wanted to set up a separate bucket for that, that's perfectly fine. Okay, so what I thought I'd do today is just go through some of these things. Argentina, yet another rescue package needed. That's not going to impact the stock market, right? Copper prices. I used to, my mentor was the then chairman of the London Metal Exchange, Lord Bagri, and so I got to know more about copper than any sensible human should. And it's a pretty good proxy for global growth. If copper prices are going up, and you're not going to be trading copper, it's a pretty good sign for the broader economy, and it's one of the things that I'd look for. You see oil prices up here, 64, it's just there, $64. As long as that's below 80, we're not going to get a cost of living crisis in the Northern Hemisphere in winter. Because if we get that, then consumption goes down, and that's going to be bad for your pension in the near term. Now, you might as well, does it matter whether something's bad for our pension? It only causes you an ulcer in the short term, okay? Because it's a bit like your house prices. Think of it like your house price. If the price of your house drops 10%, you don't think, oh, I better sell it immediately. You just think, who cares? We're in it for the long term. Okay. And that's the same way you should be looking at your pension portfolio, unless you're about to retire, in which case you shouldn't have so many equities. And I'll show you what the right amount is for different levels of stock ownership. But like I said, I want to start off with the macroeconomics or the geopolitics. One of the reasons I want to do that actually is this. I'll just share that. I've been invited by JP Morgan Private Bank to their to a breakfast on geopolitics. Now, the reason I mentioned that, their breakfast meeting, is I want to share with the public what I might see in politics, in economics, when it's relevant to what they're telling their richest clients. And the reason for that is, I think that's democratic and I think it's fair. So the reason I start all of these each week with that, with the look at the broader economy and politics and economics, is because, of course, I think it's important for you. And I think it's important for the broader market. Now, most of the time, just to set the scene, you don't have to do anything. Investing is the only business in the world where less work makes you more money. The reason most people mess it up is because not just, of course, they don't pick good quality companies which are resilient, like the tale of the three piggies. They build their house of straw, not house of bricks. We want to build it in house of bricks. What they do is they panic or they get bored. They panic or they get bored. Okay, so they mess it up even if you gave them the goose that lays the golden egg. So let me just go through some of the other things that are going on. Sky High S&P signals new normal, not bubble, Bank of America says. Some of the banks are most definitely, whether it's Goldman Sachs, JP Morgan, Bank of America, are definitely pushing the narrative to their audience that we can be cautiously optimistic. They are certainly not saying to them what the retail fund managers are saying, which is, oh, we better diversify and put little bits of money in our UK fund and this fund and that and try and find a shelter. And the fundamental reason for that is the retail clients are trying to accumulate as many assets as possible by selling you as many products as possible, whereas the big banks and the wealth managers, they're making money from you in so many different ways, and they've got very wealthy clients. They need to retain them and not mess it up. So this new normal thing, whether it's new normal or a bubble or not, I'm going to go to in a moment. But that's a pretty positive indication for now. Now, I don't know what's going to happen in 6 months or 12 months. And just because we might have a fall 6 months from now, the biggest mistake you can make is, oh, we might have a fall in 6, 12 months, therefore I better sell now. That'd be idiotic. Okay, it'd be like saying I'm not going to get on that train because it might leave the platform. It's just crazy. The other thing I want to draw to your attention is what's happening here with the US corporate bond sales. Now, that's when companies borrow money from institutions, even retail clients. Oracle has just announced they're going to borrow, I think it's well over $1 billion, several billion, if I'm not mistaken, through a bond sale. Now, why should companies which are profitable and cash rich borrow money? Well, if they can get it at a low interest rate locked in for a long period of time, then their average weighted cost of capital reduces and it makes them more profitable. It's actually potentially a very good sign if they're doing it. Apple has Apple bonds, for instance. So that is a pretty good sign that these companies have got ample cash, they're making profits, but we're going to have to stick to the kind of companies which I can sleep easy at night in, which are the types which are not borrowing because they're in trouble. They're borrowing because they've got so much profits and massive opportunities that they want to lock in those low costs for the future and just keep using that money. Imagine you could lock in interest rates of, 2%. And you could borrow at 2%, knowing you can invest and get a return on capital at maybe 10%, 15%. You'd do it all day long. Okay, you're locking in your future gains. Those are the kind of companies we want, and I'll show you how I go about finding those. Okay, US new home sales, that's all good, just adds to the broader sentiment. All of that adds to the broader sentiment. So what I'm saying is, I don't see anything from here which is negative. Now, you might say, well, if you're not seeing something negative, then surely something negative's about to happen. Okay, crypto traders bet on fresh volatility. Listen, exchange traded funds are being issued all the time, and that's because these nasty little fund managers want to scoop up the retail client money. So don't fall for it. If you want to buy crypto, Bitcoin, Ethereum, Ripple, buy some gold as well. All those four, hold it for 10 years. Don't look at it. But if you're going to try and trade it, you're asking for trouble, because these are the kinds of things that can drop 75% in a year. So unless you like ulcers or you're an amazing trader, and I'm assuming you don't like ulcers and you're not an amazing trader, then you better elongate your time frame. All right. So like I said, the ETFs are coming out because there's just a lot of money out there. There is just a ton of money, and these people want to soak it up. Right. So I'm going to leave it at that for now in terms of why investors can't seem to get enough of gold and so on. Right. So we'll leave that for now on the economic side of things, and I want to return to, well, how have some of the portfolios done, and then we'll go into the individual stocks as well. Hey Joseph, lovely to see you. Joseph, do share your URL. You shared it with me. Feel free to share it with the website, because I love the jewelry that you've got, and I'm going to be buying something from your website. So thanks for sending that to me last night, and do feel free to share it with the audience in the chat, because I really liked it, what you're doing. So what I want to show you here is, let's just go back to this, okay, and the various models. Now, the reason we create models is when the market is overbought as it is now, just historically, and there's some concerns about valuation. It is not about, I bought this stock, bought that stock, bought this stock. It is about, I bought a team, okay, because it makes it safer. If it was about bought this stock, I'd just say to you, hey, buy Rigetti or at Lovin and just leave it at that. And you can write a breathless headline, newsletter headlines, and we got this company and it's doing incredibly well. Okay, no, we want a portfolio. And that's why I'm saying to my clients more than ever at the moment, listen, I want you to think about the portfolio level, because what's going to happen is any company in your portfolio that misses earnings is going to get punished. And that's why you don't want to be gambling on individual stocks. You want to be gambling on the whole team. And so if one company drops, it's fine. It'll catch up. You might even buy into the dip, but as a portfolio, it'll dampen the downside volatility. And it is more critical when the markets are overbought like this than ever. If the markets were crashing, we'd be holding cash. If we're not holding cash, we're invested. If we're invested, then we better be invested in portfolios, not just the individual stocks themselves. And that's why we diversify, if you want to call it that, but that's why we spread the capital between them. Now, the difference is, and I'm going to show you how this works, is some clients don't mind higher volatility, and so they might get higher returns. Okay, others really don't want high volatility. They want really protected downside, and so they might get lower returns, and they're happy with it. We're going to dip into some of the portfolio construction side because it's really important. I think a lot of people don't get why they should be looking at portfolios, because they just love gambling. That's the problem. Thanks, Joseph. Thank you very much indeed. USA Jules, and I as I said, I've got my eye for my wife on a little diamond necklace of one of yours that I saw. One of the other things I want you to remember, and this is I want you to fix the roof while the sun is shining. At the moment, with the stock market at all-time highs, the sun is shining. What do I mean by fix the roof? This is the time to prepare yourself for the fact that there will be years like this. The things that I've redacted here are the names of all the stocks in the quality 5 plus, okay? The names of the stocks in the quality 5. So I've removed the names, and this is how they've performed. Okay, so there was a certain stock which dropped 64% in 2022, et cetera, et cetera. My point is that you can have these mega returns, albeit with some car crash years. Now you might say, well, why didn't you just tell everybody to go into cash? Well, we did, but we just assumed nobody listened. So we're going to show you what it looks like if you had the car crash, and that's fine, because that's the results after it. Now, the reason it's important for you to know that and do this is because otherwise what happens is people start having unrealistic expectations that you can have great returns, but none of your stocks might ever drop. Look at that. There's a stock here which dropped 30% in 1 year, yet 122, 125, 239, 171, right? The reason I say this is because if we're not prepared if we're not experienced and see these numbers happen historically, then what ends up happening is that you get into this false sense of complacency. When the rain starts, you panic, okay? Or you get bored. You say, oh, I'm not getting a return. By looking at the historic numbers of any portfolio you've got today, you think, well, that's history. Who cares? The reason history is important is it stops panic and boredom. It's why Warren Buffett ingeniously says his holding period is forever. It's not. He's lying. But the reason he lies about that is because he's making the point. If your holding period is forever, you are assuming 3 things. 1, you'll never panic. 2, you'll never get bored while the performance is dull for 9 months or whatever. Okay. And thirdly, if your holding period is forever, you must be treating it like a company which you own, and you're happy when the markets fall because you like it so much and you like it enough to own it. Okay. Now, when we look at the broader market and people make generalizations such as it's overvalued, it's going to crash. Well, yes, no, whatever. But the point is earnings. Now, in the year 2000, when I was doing my Bloomberg TV show, companies didn't have this. They didn't have profits. As you remember with dot-com boom companies, they didn't have profits. Now, I'm not saying it's different this time. What I'm saying is follow the profitable companies more so than ever at this time. Now, I'm not saying you can't speculate. You're more than welcome to speculate, but please do it in a separate part of your portfolio. Okay, don't do it in this part, which is your pension. Now it's more important than ever to have those profitable companies, because when the rain comes and it's due, and we'll look at the S&P in a second, and we'll look at some of the stocks, and you'll see what I'm talking about, the profitable companies will be more resilient to falls, and you can sleep easier. We are not talking about gambling. Now, it is true occasionally. I'm going to show you something I sent my clients today, okay, which goes back to last September. So the clients who are on here, don't panic. This is sent today, but it relates to 2 reports from 10 months ago, all right? 10 months ago, right? So the reports I sent them were the Rigetti and the AppLoving one, and pointed out that it worked well. So that's it from whatever, 10 months ago, December 10th, 2024. So let me just show you those. Now, occasionally, I get it. People want to gamble. They want those companies where they've got, and I'll just show you that one, okay, where they've got those kinds of, this is from 10th of December, okay, and it was AppLovin, where they've got a bit of fun. And when we do these reports for them, what I'm saying is, if you want to have fun, because I know it's tempting as a retail client, I know there is so much temptation out there. There's all these tip sheets and newsletters, and everybody wants a flutter. You don't want to do that in your pension. You want a portfolio. But if you do want to, I say gamble, I say to my clients, this is the higher risk stuff. You want to do the higher risk stuff, that's perfectly fine. But here's what you want to be doing for it. First of all, and I'll show you how we do these projections in a second, you need a good projection trend upwards, and you've got to make sure that it's going to give you, on the historic returns, whatever the stock is you're looking at, going to give you the kinds of returns. I'll show you an example in a second with Rigetti, the kinds of returns which it's historically performed, and they're at least 2 times more than where you're going to put your stop loss. And I'll show you that in an example. And you've got to have, I think, an exit strategy, unless you want to, I don't know, speculate forever. So with this one, I said target holding period 9 to 12 months. This kind of gain is what you'd be looking for, and then a stop loss like this. Now, the reason I'm showing you this is not because this is relevant now. It's not relevant now. It's relevant 10 months ago for the class. But what I'm saying is, when you do it, the reason private investors often mess up, even if they've got a company which is good, is because they just think, I bought it, and then that's it. They don't think timelines. They don't think, well, or if they think stop loss, they, I must get out 100% of it. Well, not really. You can set an initial stop loss, then you can have a trailing one after it's gone up a bit, and you can do all sorts of things. You can have a first profit taking level. Okay, we can sell half the position. Do you see? It can be quite complicated if you want, and that's a heck of a lot easier. What they think is, I've got to be all in or all out. Now, the reason I'm showing you this is because I know no matter how hard I try, it's a bit like those ashtrays in hotel rooms. It says no smoking, but you bloody know people are going to smoke, so they leave ashtrays in hotel rooms, even though you're not meant to smoke, because they know if you do it, at least it's safer. In the same way, I don't want you to be trading, but if you're going to be, I might as well just show you what you should be doing, whatever you find, wherever you find it. Okay? And, you know, here's an example of how you might structure it and examples of it. Now, let me show you another one we gave the clients, which was Rigetti, and I'll see if I can open that up. Yes, I can. Okay, so this was the Rigetti one from December. Okay, and again, you want to draw that? No, that's AppLovin. What am I showing? I just showed you that. Let's see if I can show you Rigetti note in a second. Before we go into the market updates and all the rest of it, okay? Let's see if I can open. Yes, I can. There it is. All right. Now, I'll show you that chart in a second in more detail, so don't worry. All of this. And it's going back to December. So again, I don't want my clients having a heart attack saying, why did you show this one? It's 10 months ago. Okay. And the reason I'm showing it is whatever you do, if you are doing some of these flutters, at least have the thesis, have an exit strategy. Okay. You might change your mind. You might say, bloody hell, this is skyrocketing. I'm not going to exit on this. Why should I? Okay. Where are you going to take profits and so on? And the tool I like using is TrendSpider. You don't have to use it. There's TradingView. There's Google Finance. There is Yahoo Finance. Okay. I don't have any relationship with any of them, just so you know. And one of the things, or several of the things you want to look for whilst you're looking for things, if you're doing the speculating end, which is the non-pension end, And for us with this one, as we explained in the document, I'll see if I can upload the document in a second so you can all look at it at your leisure. I'll just upload it across so you get an idea of the template and the way in which we do things. Whereas if you're looking at something like a breakout, okay, then you want to project forward from there as we did. What would it look like if it did the same as it's done historically? So you look at a historical upward trend and you say, well, what would that look like if it repeated itself? Okay. And where's your stop loss? Well, you probably want it somewhere where if it went there, it would suggest your initial thesis is wrong, that it was going to go up. So you might put it here. And then you look at the distance from the entry to the stop loss, and it has to be that it's less than 1 times, the reward should be 2 times the stop loss, in other words. So if that gain is going to be, I don't know, 200%, this fall has got to be less than, obviously, 100%. So you want at least 2 to 1. And that should protect you, okay? Now, that's complicated, and you might say, you know what, Alpesh, you're right. I shouldn't be speculating because I don't do this, and I have no desire to do any of this, so I'm not going to do it. What I'll do instead, thank you very much, Alpesh, is I won't do that at all. I'm going to see if I can upload that file actually for you. Add a new file. Getty. I'll see if I can upload it whilst we're sort of speaking on any of this. And if I can, then I'll be a bloody genius, won't I? Okay. So, and the reason I want to share that with you, just so you get an idea of how things ought to be done if they're done professionally. You know, it's a bit like when I was at university. I'd say to the tutors that I don't know how to write a first-class essay. Do you mind just teaching me? Or show me an example. And I just think it's a hell of a lot easier when somebody shows you what something should look like and something that's worked as well. So you know, oh, okay, that's what a worked example should look like. I'm going to see if I've done it now. Yes, I have. It should hopefully appear, if you're watching the webinar, which you all are, is no, the personal status code. I'm going to try again. If not, don't worry. No. With status code 404. Okay. Well, it doesn't matter. Anyway, it is what it is. Won't work. Now, if you want to take a screenshot on a photo, feel free. Okay, that's the first. Just take a photo. I mean, talk about advanced bloody technology. Here you go. Take a photo. I'll try and save it onto Google Drive and send you a link to the drive in a second. And that's basically the structure. All right, and I think this is the most important structure. I'm going to actually try and save that to Google Drive while we're talking anyway. So excuse me while I'm sort of doing this in probably not the normal way in which I do it, these webinars, but it occurred to me whilst I was doing this, you know, this is going to be useful for you. Webinar live documents, okay? So I'll create that, and whilst I'm talking to you, we'll do it. So I'm going to put that to one side, and I'm going to keep this open because I can always look at other stocks later on as we go through things, and hopefully that was useful. And similarly with this one, what I'll do is I'll shove it into downloads, okay? And I'll put both those on Google Drive, and I'll make sure you've got the link in the chat for that Google Drive in just a second on here, so at least you'll be able to see exactly what I'm talking about and why I think these things are important. But anyway, going back to this part, earnings are there for these companies, and they're going to be really important. Portfolios are going to be important. I'll come to this in a second. I also want to show you on here, not that bit, I want to show you the articles. If any of you are looking at why fund managers and funds underperform, if you go there, you'll find on my blog, which is on that website, a bunch of articles which goes into it. A lot of you have asked me about Fundsmith, Vanguard Life Strategy. It's all on there, okay? Now, why am I saying portfolios are really important at the moment? The reason I'm saying portfolios are really important at the moment is this, right? Stock A, stock B, when you put them together, you get this. Now, what on earth am I talking about there? And I'm going to show you right now why portfolios are more important than individual stocks. Individual stocks are great if you're trying to sell some kind of tip sheet, which is, Warren Buffett hates them for obvious reasons. They just sort of are breathless about whatever the flavor of the month is. When you're talking about a portfolio and you're mixing stocks together, what it's getting you is, put to one side the annualized return since 2017. Amazing, fantastic, always half that. Half of that would mean you double your money in 5 years, okay, which is what property used to do back in the 1980s. Sadly, it doesn't do that anymore, okay? Ross, I'll mention the averaging up thing in just a second. It's a great question. This is the bit. That's what's going to kill you, okay? It's the drawdown. And what do I mean by drawdown? I mean this, okay? This is what I mean by drawdown. And this is the bit that messes people up. And I'll show you why you're going to mess your pension up if you don't listen to this bit. Okay, I want to show you Microsoft. And I give this as an example. And this is Microsoft in 2021. I want you to look at it in 2021. All right, and this is 2021. On Microsoft, I always tell people, went up about 58%. All right, you're not going to believe this, but 9 of those 12 months, it was flat to 0. And you might say, what the hell are you talking about? Well, there you go. Well, what's that? 1% up. That's pretty much over 4 months, 1%. Okay. Then you had this period. What's that? Another 4 months, 0. So over 8 months, 0. Let alone the fact that there were periods in there where it fell. That's what? 8-9% fall. Let's just remove this. So you can see it there. Okay. Bit less. Right. So you had roughly 8 to 9 months of no gains. And then you had several periods where within a few months, 1 to 2 months, it was falling over 5, 6, 7, 8, 9%. Yet it went up 58%. The point is, panic and boredom will kill you. Why will panic and boredom kill you? Well, I'm going to show you here. Panic will kill you because you get a drawdown. And so you panic. In a portfolio, panic gets dampened. Why? Because of this. 2 stocks combined, and that's why I want you to think portfolios, because I'm telling you right now, you're about to experience in the next few months some sharp falls. And when those happen, if you look at stocks at the individual level, you may even get out at the bottom. And by removing a stock because you've panicked, you're going to be exposed to even greater risk because you're going to have removed the dampening effect. And you can't understand it, you can't see it. I think it was William Sharpe who got a Nobel Prize in economics for putting this together. Okay? So I think it was Sharpe. It might be wrong. It might be Markowitz. It's either Markowitz or Sharpe. It's one of those two. Now, that's why we're going towards that. So how do I stop your panic and your boredom? Right, let me tell you what panic and boredom are. You might say, no, just give me some stocks, give me some stocks. You're going to F it up. It's like saying, give me the golden goose. Give me the goose that lays the golden eggs. I'll give you the bloody goose. And you're going to kill the goose. You're going to sell the goose. You're going to prematurely make it kill itself by laying too many bloody eggs. Or you're going to say, it's been a week since it's laid an egg. I don't like it. Or you're going to say, oh, this egg's quite small. I'm going to kill the goose and eat the goose instead. It's what you're going to do. All right. So that's why I'm telling you the boring stuff. This is the stuff that Warren Buffett tells you, and nobody listens to the poor old man, and even though he's the richest man in the world, or was. Okay, underwater, the underwater period is what will cause boredom. It's going to happen. I just showed you with Microsoft, even on a 58% return. Drawdowns is what causes panic. Now, this is not to say you can put any rubbish in your portfolio and you're going to make loads of money. What we show here is every single stock in a particular portfolio that a client's chosen. They choose their own portfolios based on our filters. And then every single month. And we look at every month where the stocks might have gone down. And I show them. I say, look, here's a portfolio which has generated 31% per annum. But there was a month where every single stock dropped and some of them double digits. And here's a time when month after month after month for 5 months, the stock kept dropping. And yet that's a 31% historic return. When people don't look at history, I mean, look, it's the same in life. If you don't bloody read history, you're bound to make the mistakes of history over and over again. I shall tell you the funniest thing. Historical data is available for free. Nobody ever has the idea, well, let me bloody well look at it then. Has this happened before? It is incredible. I'm sharing this with you as retail, because you're retail clients, so you don't make the same mistakes that people make time and time and time again. Because what they've heard is stuff in magazines and newspapers and the internet, and they just basically don't know the right things. Let me go into this. Ross, thank you for your questions. I will come back to this. White screen, not again. Screen is white screen. Let me just turn it on and off. Entire screen share. Okay, how's that? You should be able to see it again. And I'm going to go back. Sorry that there's sort of screen issues. I'm not entirely sure why there's IT issues. We use Google, we use other third-party companies. It's not, I haven't invented PowerPoints and software. So apologies that it's gone on there. This is what I was showing people about drawdowns, okay, and underwater periods. Hopefully it's all there, sorted. If there's any problems with the screens, just let me know straight away. I'll keep an eye on the chat and I'll basically turn it on and off. I think the signal goes for some reason and I'll turn it on and off. I can even turn my video signal off to save some of me talking. In fact, I'll do that for now. I'm going to turn my own video off. You can still hear me, and that might save some of the bandwidth if it's bandwidth which is causing a problem. Okay, so that's the point I was making. Underwater is what causes you boredom. Drawdowns are what causes you panic, right? Everybody loves the returns. Nobody likes everybody likes sausages. Nobody likes how they're made. All right, and put it another way. I'm going to come back to some of that stuff in a moment. Well, there's one other point. There's a family friend I was speaking to earlier today. Oh, and this is the bit where I said, I don't know if you saw that earlier, where every single stock which is in there and the months and how the whole portfolio goes red. Some months every stock drops, and some months stocks drop month after month after month. So you look at the horizontal and the vertical. I was explaining to a friend that if you look at the historic movements of your portfolio, what you're really trying to work out, a bit like flipping a coin. If I said to you, I've got a coin, but I don't know if it's 50-50 or 60-40 or whatever, and I say I flipped it 10 times, here's what it looks like. And you might go, well, it looks like a 60-40 coin. But if I said to you, I flipped it an infinite number of times, you'd know for sure. Well, what this does is it flips the historic movements. And it says, well, these individual stocks are like coins. They tend to go up 60% of the time in the case of, say, Microsoft or Costco or Walmart or Intel or IBM, whatever. And then it shuffles all of them simultaneously and says, well, over 3 years, there's a 90% probability you get this amount or less, and a 10% probability you'll get more than it, or a 50% probability you'll have more than doubled your money in 3 years, etc. That simulation makes a lot of assumptions that history will repeat itself in terms of how the stocks have moved, they'll move again. But it's a useful guidance to know, to have a safety mechanism. Now, you're not going to create that. Okay, I appreciate that. But what I'm trying to say is, these are some of the things nobody ever tells you about that goes into what should be giving you peace of mind. Okay. Now, another important point I want to tell you on Ross. Again, I will answer your question, but don't worry. People often ask me, Alpesh, this market's been overbought. What should I do? Because you and I don't have a crystal ball and we can't see into the future, the only thing we can do is look at our own risk appetite and say, well, what's my risk appetite? If you start determining your risk appetite based upon gambling on the future, and I think I know what Donald Trump's going to say next week and all the rest of it, you're simply asking for trouble. So I say to my clients first, I said, well, what's your risk appetite? And they say, well, I don't know. I want to be like you, Alpesh. And I said, no, you don't, because I like bungee jumping without a rope. Do you want to be like me now? If I jump into a well, will you follow me? You know, as your parents used to say when you were little. No, you don't want to be somebody else. Now, I can tell you where I am at the moment. I'm happy to be here. Okay. That is where I normally am most of the time, sitting. Occasionally, I might go here. Now, Ross, just in terms of your question, which I'll come to, it's sort of slightly there. I want you to look at these drawbacks in advance. Very simple. Take a photo of this. Okay. If you're highly risk averse, which would worry me, 2022, I'd be that. Now, why in 2022? Now, this is in the public domain, so I'm not giving away any great secret, and I've said it many times before, so I'm not sort of, whoops, I want to show you why in 2022, and I'll keep an eye on the chats so that you can see. Okay, so what was it in 2022? With indices and exchange traded funds, which are generally index trackers anyway, whatever the basket of stocks is, they tend to generally follow a pretty useful pattern. They're not guaranteed to, but generally, as a general rule. And basically, it is this. If we look at moving average prices, and that's what this is, it's the monthly, which is that, and the weekly, which is that. Okay, and this is both of them overlaid. I'm just focused on the monthly here for a second. So let me just show you the monthly. If the green goes below the yellow, just pattern recognition. What tends to happen is it's saying short and medium term prices are falling. You might want to get out. I call that a daddy bear. Okay. The earliest I'd ever consider getting back in would be if the monthly, bottoms out and is rising. Okay. That's the earliest. I'm going to show you a picture of that in a second. Now, 2022 was a time when we were largely in cash. I don't have a problem telling my clients we're largely in cash for the simple reason that I don't have a conflict of interest with them. I'm not trying to sell them a newsletter subscription where I'm going to keep trying to come up with stock picks even when the markets are rubbish, or keep them in my retail fund so I can earn fees off them. Okay. Now, the point is, where are we at the moment? Well, you can see it's similar to where we've been in the past before falls, but we're not there now. Now, this is a really important point. Just because something might happen in the future doesn't mean you prematurely anticipate it and do what you would do when it happens, but do it now. That would be stupid and irrational. Yet private investors keep doing that. They say, I think there's going to be a crash in 50 years. I think I'll exit now. I'm exaggerating, but you get the point. Okay. So am I worried? A little bit. So how did I determine that I'm here? Well, you can see why. I don't want to be totally risk loving, although because of this, I'm now fully invested. By fully invested, I mean I've still got about 10, 15% in cash, because I always keep 10, 15% in cash because I grew up in Leeds. And just early upbringing, just keep some cash. So that's the S&P, which I just showed you. This is the point I'm making. You can feel free to take a picture, because you can take a picture of this, print it out, keep it on your desk. Now, I don't want my clients again to have a heart attack, but I've printed this in my books in the past, obviously from the period of when I wrote the books. And the point of it is, there's no guarantees. And where are we at the moment? Well, you'd probably say we're still at number one, which is this bit. Okay. We're not at number two, which is sort of when it's just starting to flatten. We're not there yet. But what comes after one? Two comes after one. But we're at one at the moment. Risk loving will buy 70% chance of a 10% drop in less than 6 months. This is a pretty good estimate. All right, that's what I share. So when people go, oh, what's going to happen? What's going to happen? Now, I didn't at that point talk to you about US dollar or Donald Trump or the United Nations or global conflict or macroeconomy. What I did is I said, I'm going to go by where people are putting their money. I don't care what they say. I care what they do. What they do is where they put their money. And if their money is going in and we're at 0.1, that's fine. If their money's coming out, we're at 0.2 or 3, that's fine. In other words, I think people lie, but their actions don't. Yeah, and that's the principle behind that part. And that sets the scene for me. Now, I'm not going to anticipate 0.3 today. All right, so I just want to explain in more detail why I say some of the things I do and where they come from. Right now, when I'm looking at investments, and this is from my very first hedge fund document in 2004, would you believe? And you can tell because it looks a bit sort of dated PowerPoint. This is what we're after. We're not after just value funds or value stocks, because that'd be stupid, because something can be undervalued, i.e. lots of profits, low share price, because low share price compared to the profits it makes, because it's rubbish. Could be undervalued because it's making no money at all and just got a good discount cash flow. So I don't just want undervaluation. I need them to be undervalued and growing. I don't just want growth stocks because they might be overvalued, about to crash. And what we know from the academic data is also that companies delivering dividends tend to have a bit of a buffer from falling, because if the price falls, the yield goes up, i.e. you could buy more stocks and get more dividends, and therefore you're earning more money from dividends alone. So it gives them a natural floor. Okay, so if I can find the sweet spot, now that's not to say there might not be companies here which do incredibly well, or here, or even in crypto because Trump does a message. I don't care. I only want to look at these so I get a good night's sleep and I make enough. That's also the sweet spot of Warren Buffett, by the way, just so happens. Okay, that's simple. I can sleep easy. Sleeping easy is very important to me. How that's done, value, growth, income. I happen to look at cash flow, but I look at this. You might want to look at other things. Momentum is important to me because it comes from the hedge fund industry. Trends tend to continue, but they're not guaranteed to. Sortino is really important. And again, it's from the hedge fund industry. And you can cheat. You can cheat. You can just simply, you want things to be green across all of them. So you can cheat and say, well, I'll just take the ones which are all green. Again, that's what I would do. Now, does that guarantee some amazing returns? No, it doesn't guarantee anything. Nothing guarantees anything. Does it mean things not selected and won't go up? Of course they might go up. Warren Buffett in his entire career never had a portfolio where every single stock went up in a year, and never had a portfolio where that year's best performing stocks were in his portfolio. So think about it. And yet, world's richest man. We're not trying to be perfect. We're just trying not to panic or get bored and have some good companies. Good companies, no panic, no boredom. You make a lot of money. All right? So let's just go back to what's happening this week in the markets. We've got some earnings coming out. Costco, Accenture, Jabil, Paychex, all good companies, except they're not going to move the markets. Their earnings aren't going to move the markets. They're not going to affect the markets, but I just thought I'd point them out to you. When we do things the way we do, we're not as good as you might possibly wrongly think. Let me explain. If we were good, then we wouldn't be so reliant on the market tailwind. In 2024, there was a massive market tailwind. That's why returns were amazing, not because we're amazing. If we were good, we would have invented NVIDIA. If we were good or amazing, we would have said just buy NVIDIA or MicroStrategy and nothing else. If we're a newsletter tip sheet, then we'd say, oh, we got MicroStrategy, aren't we amazing? Well, no, because you'd be an idiot if that's all you bought and nothing else. In fact, you're going to bankrupt your family, I guarantee it, if you only buy one stock. Okay, over your lifetime, you will bankrupt your family because you've got the characteristics of an absolute insane gambler because you bought just one stock. That's why tip sheets are dangerous. Okay, they're high octane fuel for stock market cokeheads, right? They will blow you up. They're geared towards it. Right. If we were good, we would have got 150% in 12 months or 515. Well, just because those stocks ended up in our portfolio, they were actually a relief because we didn't know they're going to go up that much. If we did, I would have said just buy that. They made up for the ones which delivered far less than 41%. Think about it. Simple maths. If that's up 150, we must have had some which had negative returns. Yes, we did. And if we were good, we wouldn't have needed to cheat a bit by having triple leverage NASDAQ. Now, you don't need to have that. Don't have NASDAQ leverage. In fact, if I were you, I happen to like it. But that's because of personal taste. And you quickly realize, I'm going to show you some leverage in a second, why, oh my God, I don't want that ulcer, because it'll give you a bloody ulcer. All right? So what you've got to realize is the reason even we have portfolios is because we do not know how much something's going to go up. We think we've done the right things, but sometimes, even after all of that, stocks fall. There has never been a year in his entire history where Warren Buffett has not in his portfolio had a portfolio where no stocks have dropped. It's never happened. Okay. So what's the past year look like? Now, there's some important points I want to raise here. If you said to me 12 months ago, those who've been following me will know, if you can follow my YouTube and all the rest of it, that I own JP Morgan and Goldman Sachs. And even through the falls in February and March and April, I held on to them. Okay, because they were on our filtered list last year and I held on to them. Now, if you said to me 12 months ago, and this is over the past 12 months, that my JP Morgan holding will go up as much as NVIDIA, I would have said you're insane. You would have said I was insane. Okay? If you said to me 12 months ago, Alpesh, your Goldman Sachs holding will go up more than NVIDIA in 12 months, I would have said you're insane. And if I told you that, you would have said I was crazy. What's the point I'm making? I'm trying to show you in, well, green and white, not black and white, that the moment you start to try and gamble on, oh, well, Envy, it's so obvious. Look at all the narrative. Well, where the hell was the narrative saying 12 months ago, saying Goldman Sachs is going to outperform NVIDIA? Nobody wrote that. I didn't know it. I didn't write it. I didn't know it. I would have bet against it. So if you would have bet against it, Alpesh, how the hell why did you have Goldman Sachs, JP Morgan, and NVIDIA? Well, because I didn't know that they would do that. First of all, I had no idea Goldman Sachs would go up 65%. I thought they'd give me a good 20, 30 if I'm lucky with a tailwind. I didn't know there was going to be a tailwind. Notice how much I'm telling you I do not know. Okay, this is the problem that people have. They go, oh, you must be the guru, you must be the pundit. Useful because they're Indian terms, but no. All we know is that if we have a house full of bricks and there's a storm, the house shouldn't fall, but a house of straw is guaranteed to fall. Okay, that's all. So that isn't, by the way, diversification in the traditional sense. Oh, well, you had financials and you had semiconductors. No, they can both fall. When the markets fall, this will all be red. Right? Where's your diversification then? Now, something else I want to point out to you. I don't own Costco at the moment, but as I've often said, I keep an eye on it because it's one of those which gives us some good years. There's others which I don't own at the moment, such as, I don't think it's in one of our models, say ServiceNow. But I know it's going to give us some good years in the future. We tend to keep an eye on it. Lam Research, which gives us some good years. Don't own at the moment. You dip in out. Then there's others which you will know, and I've put it in the public domain, which I tend to own most of the time, the 2 M's and the 3 A's, Meta, Microsoft, Apple, Amazon, Alphabet. Okay, you know that. I've said it a million times. Okay. There's others I don't own, which might do very well. Oh, but if you're so clever, how come you didn't own Palantir? Because if they're IPO companies, i.e. they've only just listed in the recent couple of years, we don't have enough data. And so we missed it. And that's fine. I mean, I did do a separate stock report on it, like I showed you with Rigetti and the others, but I would have put it in the high risk warning category to students to say, listen, watch out, could be a bit high risk. If you said to me 12 months ago, Oracle's going to do better than NVIDIA, well, this is, you're crazy. And we don't gamble on those narratives, or indeed Tesla, my God. Now, I don't own Tesla at the moment. I have in the past. And you'll know why I don't own Tesla, because I don't want the ulcer. And there's also another reason. I want to prove to people that it's okay not to own something, even though you think it's going to go up, because you don't want the ulcer. It's like a woman I used to date before. It's okay not to date a beautiful woman because you don't want the ulcer. Okay? Think of it like that. Never marry your stocks. But if you don't want the ulcer and you still think you're going to make money out of it, let it go. Retail clients make that as a classic mistake. Okay, I've got one client who's obsessed with Netflix. I've never understood it. And I said, I'm only going to have it if it's on the filtered list. But, you know, because I don't try and understand the narrative. He loves the narrative. I said, I have to go by the data and the stories. Anyway, I just thought I'd show you these. Now, healthcare at the moment is getting a bit of a whacking, and there's going to be some opportunities coming up there, but only if it's part of a portfolio. And think about it. Let's say you had a portfolio with these. Now, can you see why I want you to look at portfolios? Who the hell knew that Trump was going to kill a lot of, tell people to stop eating paracetamols? I think a lot of the American paracetamols are imported from India, which is why he's a bit against it as well. The portfolio effect means these will make up for these. We're not trying to be perfect and get everything right. We couldn't be, ever. Okay, and that's really important to understand. So where are we over the past year? Well, the NASDAQ. Now, this is the tailwind. If we were clever, we could get 45% returns in a falling market. Let me tell you something. I can't. I'm not that good. Nobody is. All right? Unless there's some specialist hedge fund, and they do exist, who in down years do incredibly well, but the rest of the time are crap. Okay? But it ain't me. Not my skill set. In a falling market, my best skill set is to stand out of the way and hold cash. My skill set is not in shorts, i.e. shorting. And trying to profit from falls. It's not how my mind works, my brain works, okay? Very important. When you get older, you're more than confident to tell about your limitations. In fact, you're well aware of all of them. 99% are limitations. 1% you can do right. NASDAQ, that tailwind is what protects us. Now, let me tell you what happened earlier this year. Okay, and you have two options when the markets are in a daddy bear. One, you could hold through it. And if you've got a portfolio which has been tested like a car, has been tested through a crash test, that's fine. Hold through it. Okay, because you've already tested it and you can just buy and hold. If instead you want to exit because you fear it might be like 2022 and fall a lot further, then the risk you take, and it's a risk I was willing to take, is that you bought some insurance. In other words, you sold here, but you might have to buy back higher. That difference is the cost of insurance. What's the insurance policy against? The insurance policy against the market falling even lower. Is it an insurance policy you're willing to take? I would think so. And I'll tell you how I tell my students to make that decision. Here it is. I'm going to show you something, and I want you to take a picture of this. And I've shown it before, and I've done versions of this in my previous books as well. It is, oops, where's it gone? There it is. It's this one. Okay. What should I do? I get asked this so much. 1, 2, 3, 4, 5. That's it. Take a picture. Okay. What should I do? This is, some of these slides I want to get printed up and posted around my house because, well, my wife will kill me, but I just think they're works of art. I love it. I absolutely bloody love this. I want this on my wall in my office. So I just think it's art. Anyway, feel free to take a picture. So there's nothing wrong with getting out. If you're trying to be perfect and get out at the tops and bottoms, which is what the stock market wants you to try and do, it's what the journalists want you to do, it's what the newsletters claim they can do, you are going to lose a lot of money. You're going to drop the ball on a 58% return in Microsoft in 2021. Got it? Well, that's important that you realize that you do not want to be in that position. So how's the year been so far? Now, look, again, if you follow me, you'll know I own these with the exception of Palantir through the model portfolios that I have. All right. But there's 44 stocks in the portfolio that I have. So you wouldn't just buy these, right? Palantir, I wish I had it, but we did it as a stock report. I don't own it because of the IPO thing. This is the UK. I'll do a separate version on the UK, how they've done in the past year. And some of them don't. I mean, Rolls-Royce continues doing really well. And people often ask me, what should I do with Rolls-Royce, Alpesh? And I say, look, if it drops X, sell Y. It's probably the easiest exit rule I can give you on a webinar. What that means is ask yourself, if it drops X, i.e. 5, 10, 15, 20, 25, 30, 35, 40, what's your Y for your risk appetite? If it drops 5, how much do you want to sell? You might say 0. If it drops 10, how much do you want to sell? You might say 20%. Okay. And when you do that when the sun's shining, it means you won't panic when it starts raining on Rolls-Royce. When will that be? I don't know. It's not your job to try and predict it or forecast it because that's a fool's game. Okay. NASDAQ, that's where we are. It's overbought. What do I mean by that? Same as the S&P 500, all-time highs. It makes me lots of money. What can I say? The leverage part of it is stupid because you go from 200 to 600. And I don't recommend 3 times leverage. And obviously in 2022, we had to exit that. And here I had to exit it during part of that and buy back more expensive later, which is fine because it's leverage. So I don't mind doing that. FTSE 100, near all-time highs. But again, overbought. You'll know I'm very much more US based because I make more money. I spend it in the UK. I'm tax resident in the UK, just so you know, and a British national. But I love the fact that I can make money out of the Americans and spend it in Britain. Joseph, love it. I have this. My son has this. Okay, so it's the 2 times over. I don't recommend it, and I'll tell you why. And this is the mistake people make. Okay, do you see this bit? Drawdowns. You look at these numbers and how quickly you can have a drawdown because it's leveraged. That's the ticker symbol. Don't do it because drawdown depth and duration means you take your eye off the ball, you're going to be underwater and you're going to be down a lot. You really are going to want to panic. Okay. Trust me. You're not going to say, oh, it's all right. Alpesh said it should go back up eventually. No, you'll be throwing up because if you lose, you go from 2000, you lose 50% in 6 months of your pension, you should rightly throw up. It'd be irresponsible. If you only go back to break even 2.5 years later, you should throw up. Okay, so don't do leverage unless you don't do it. I'm just going to leave it at that. Okay, so I'm holding this at the moment. I don't have a problem. I'm of course watching this. That's why one of the reasons I like doing my weekly updates is it actually forces me to look at it and not ever be asleep at the wheel. Yes, my students will know I'm in this. I'll disclose a little secret. The earliest I'd ever get into these is when goes from flat to rising. Okay. Now, if this goes from flat to rising and this starts rising, yeah, you get a bit of a sweet spot and a bit of a bump up before a bit of profit taking. Okay. Usually that kind of pattern. Sooner or later, this is about to, as that approaches it, this will take a bit of a pullback. Just so Apple's going to have a bit of a pullback before resuming upwards is what I think. I don't know from Holly. I don't know which way it's going to go. Do I care? In a way, no, because it's part of a portfolio. I don't have this yet, but I know I will in the future because this hasn't quite flattened out. And I know when I do, it'll take me from 60 to 120. It'll double my money. And even if it took 3 years to double my money, it's a pretty good rate of return. Okay. But at the moment, I don't have it, and I'm not going to prematurely enter it. Now, these are all little messages, which I think are important to tell you the way I'm thinking. Can people just type in, or somebody just type in that you can hear me? The reason I say this is because nobody's posted this chat for ages, so I'm a bit afraid I'm talking to myself. McKesson, the reason I've shown this is classic example of a good company, but it sums up the market in good companies at the moment. Okay, it sums up the market in good companies. And what's the market in good companies? By good company, I mean value, growth, income, cash flow, Sortino, all in place. Nice, simple trend, not volatile. Years of consistent returns, no volatility. You project that trend line forward, you get a lovely, nice return. However, go on, Alpesh, spoil the party for us. Well, it's not this bit that for 11 years, September and October are bloody awful for it, and so is December. That's not the point. It's not that, hey, look, Morgan Stanley say buy, Wells Fargo say hold low, Bank of America say buy, UBS say buy. No, none of that. The problem is this, okay? When you're at this top end and you're trying to break through, and this is what Bank of America are talking about, saying it's the new normal, but it's not a bubble, is what they're actually saying is that we can break higher, okay? And this might continue going up. I don't know. It should. But one thing I will guarantee you is you're going to get this. That's your panic, drawdown depth, and duration to break even again. Duration is your boredom. All right? So drawdown depth is your panic and your boredom. You can write that down. It's really important you understand this. The reason I say that is when it happens, don't bloody get bored or panic. You'll be so tempted to trade. You know why companies like CMC and IG give you so much data? You think it's because they're trying to be nice to you. No. Behave. It's because they want you to trade. Because if you keep trading in that, if you just buy and hold something, they're not making any bloody money out of you. Okay, they're making £20 platform fees a year. They need you to churn. They need you to take their addictive drug. They're a drug dealer. And they need you to keep asking for more supply. The one thing they hate is Alcoholics Anonymous. Alcoholics Anonymous for investors is pensions. It's what I'm telling you. They hate people like me because, guess what? You're not using their drug of trading. Autism, classic example. Now, they're all looking like this at the moment. Okay, they're all looking like this at the moment of the quality companies. And you're going to hear that on the news a lot. The big wealth management companies, the JP Morgans, they're all saying go into quality because we're a bit overbought. Well, what I'd say is go into quality portfolios. They're overbought, but we're not going to panic. And that's why I think having mentors, is useful. Okay. I want to show you a few other things that I want to tell you, which are really important. I've done an absolute revamp. Now the screen might have got, All right. Now, has it gone blank screen? I'm going to turn that off and then I'm going to go, entire screen. I'm going to share it again in case it went blank, and I'm going to share myself as well. Yes, can hear Alpesh. Right, good, you're all there. Now, what I want to show you is, first of all, on the YouTube channel, I have, you can ignore that, estimated as 1,000 to 4,000. I don't have adverts. So I don't get 1,000 to 4,000, although I've got 256,000 subscribers. but apparently that's my estimated earnings. Well, a load of rubbish. Through YouTube. Which would be nice if it was, but I just don't do adverts because I don't want adverts blocking people sort of getting in the way. Anyway, the reason I'm telling you about the YouTube channel is we've got it between Fix Your Pension, and I've also done, and this is new, pension reviews, the most popular funds. So I've just done Fundsmith. I've done a whole bunch of other funds, which you can look at, and it'll show you popular ones, St. James's Place, and a bunch of others, which I'm going to put up more of on there, which will sort of Scottish Widows should be on there as well, somewhere, which will sort of show you I think you've got to go into Play All, and it'll give you a review. Let's go down there, and it'll give you, a whole bunch here. There you go. Workplace pensions, Scottish Widows. There you go. Worst funds, Vanguard, as well. So 7 investment managers, and the errors they make and all the rest of it. So it's all over there. That was just 21 hours ago. So guess what? They're not as popular as me dancing. So I wanted to draw that to your attention. But there's something else I really need to draw to your attention. We've updated and upgraded the pension calculators, the safe withdrawal rate calculator. Now I want to show you this. This is on campaignforamillion.com/tools. It's all free. It's all free. Okay. Now we've upgraded this. I know Ross Fundsmith have been generating 5% a year for the last 5 years. He's rich. He's fat. He's in Mauritius. Safe withdrawal calculator. Now imagine, I don't know, let's say you got 250,000. Okay. And volatility is 15%. Now, let's say you get one of the models and it's been generating 30% per annum. But let's say we take half of that, which is closer to the S&P over the last 15 years. So we sort of play it safe and we say, no, I only get half of that. And you're going to keep adding a bit into your pension, and you're going to start withdrawing at 65, but you think you're going to live to 90. So what this does is what's called a Monte Carlo simulation, and it works out the probability that you're not going to run out of money and how much you might be able to withdraw in 10 years when it's time to withdraw. That looks good. Okay. And what your safe withdrawal rate is, because you don't want to under withdraw, you don't want to over withdraw. Now you might want to play around with these because you might, well, actually I want to leave some money for the kids. So no, I don't want to take that much out, etc. But it also shows you best and worst cases. It shows you on a Monte Carlo simulation, well, what happens if you get a really bad set of returns? Because remember, you could have an average return of 15%, but it could be 0.0000 for 10 years, and then for the next 20 years it gets 30%. So what happens there? So I wanted to completely free tool. It's campaignforamillion.com/tools, and we've got an upgraded one here. The reason I say upgraded is because it gives you all these little explanations here as well. So we've added more explanations down here so you can understand what it does and what all this is, and run the stress test. So what this does is it says, well, what happens if when you're withdrawing your money, you get a lot of bad years? Okay, so let's say you're unlucky. So you still get the same average return, but you just get a lot of bad years up front. What's the worst that could happen? What if you get lucky? And what's the median scenario of how much you might be worth, depending on how much you're withdrawing and so on. And in the worst 10% of cases, you run out of money in 17 years. So it allows you to, obviously you wouldn't just do this once and stop. You might keep updating it each year so you know, but it prevents you from running out of money. Okay. And it's called sequence risk. And there's nobody anywhere that I know of whoever looks at sequence risk. Even the most sophisticated wealth managers simply don't look at sequence of returns anywhere. So I just wanted to let you know that we've got that. And then we've got the standard pension portfolio with the projection, 30 retirement, savings, monthly contributions, annual returns, and so on. And what might you have today, midpoint retirement? That one's just easy, and you could get stuff like that elsewhere. But we created those three. Although I think with some of them there's tax rates, you can work out your own personal tax by speaking to your accountants. I've tried not to make it overcomplicated. Oh, I've got to give you that link, okay, the webinar live documents so you can see them. Give me 1 second. I'm going to give you the link. Anyone with link? I'm going to go back and answer some of the questions. Anyone with link? Done. I'll put that into the chat. Give me 1 second on the chat. Paste. Here we go. So you should hopefully now, oh, wait a minute, webinar live. Let me just pull those documents in, which I thought I'd done. Should be in there. For God's sake. Let me upload the files again, he says. Can you believe it? Just start hating tech after a while, don't you? Oh, right, they're in there now. They're in there now. Okay, so you should be able to see the 2 stock reports so you sort of get an understanding of how and why we do things. Okay, do you know when to add to a stock? I average up. Thank you for that question. I call it adding to winners. Now, there's several ways of doing that. I'm going to show you a slide, which is, so if you're risk averse and then you think about adding, now you can either pyramid in, well, let me just explain what all that means. Okay, because I created something for clients on that. Now, if you want to keep it simple, you'd never do that. What you'd do is you just bought some stock and it goes up and you don't bother adding more. And you don't want to be unbalanced by having one stock outweighing the rest of your portfolio. Okay, so let me see if I can find that averaging up side. Here we go, adding to winners. All right, so I give this to clients so they understand. You don't have to do it. Pros and cons for each. Time-based, skyscraper, pyramid, inverse pyramid, volatility-based. They get more complicated. And you'll only know in hindsight which was the best one to do. Thanks, Alpesh. What use is hindsight? It isn't. Okay, it isn't anything useful. I also want to show you that, so you can take a photo of that if you wish. I'll come back to it. If you go to alpeshpatel.com/links, you've got a ton of, I've updated this as well. So there's a lot of free material here, including some of the model portfolio examples, pension calculators, all the stuff that I've told you today as well. There's something else I want to show you. Don't forget on my LinkedIn, you can follow me, which is on the alpeshpatel.com/links. If you go to the LinkedIn as well. Look, for any of you who are interested in the Great Investments Program, always happy to take people on. I normally say 10 on a webinar. I'm not going to say that this time because I've been a bit busy. So I'm going to just restrict it to first come, first serve, 2 or 3, and that's it. But if you want, it's alpeshpatel.com/shares. And you get all the data, you get me for life. It's a one-off as well. So, and for the webinar, I was good for the 40% off. So alpeshpatel.com/shares. If you want to join in, okay, it's all there. So for those who want to, who've liked a bit of what I've said as well, I need to show, to pull up in Excel. Give me a second. Well, I'm going to see. I'll just pull up the Excel for you. Now, the way I do it and what the clients will have is I want you to think of portfolios as 2 things. Think of it like baking, okay? One is you've got an ingredient and recipes, and you might want to make your own cake. Just share the screen again. Okay, baking. So you look at something like this. Clients don't have a heart attack. These are all the stocks that don't make the cut, okay, because they're not green across the board. And we go through 10,000 across London Stock Exchange, New York Stock Exchange, and the whole bunch. Now, the reason I'm showing you this is some clients say, yeah, I want to bake the cake. I want to take these filtered, which is this button down here. That you can see where my mouse is at the bottom of the screen, okay? And they want to bake their own cake. Most, we've discovered, actually, and I should have worked this out sooner, prefer it for us to bake the cake for them and give them a model portfolio, and then they add and remove things, and we run the numbers, and they give them the data of how it performs if they take out, I don't know, a Tesla and add an Intel, for argument's sake. Okay, so there's 2 ways you can look at investing, and I want you to look at it that way. I want you to look at it as portfolios, not as individual stocks, which is the danger I think people have when they look at it like that. Ross, you have some questions. Obviously, this is great advice. I currently have S&P Global in my portfolio, which is as high as 550. Now it's in drawdown for 90. I'm wondering if I should sell in case it drops. Look, personally, you know where I am on the S&P, you know where I'm on the global stuff I'm in. You can see it from the markets at the moment, so I'm not worried about selling anything. What are your thoughts on averaging up? I think I've just mentioned that. rotating out and buying into those that do well within the portfolio. I tend not to do that, because whenever I tend to do that, sometimes it works, sometimes it doesn't. So there's a process. The process is it on the filtered list, i.e. approved list and filtered, or is it in a model portfolio and then you let it be? What I would say to you is, if you've got a hypothesis, sell the losers, buy the winners. Have you tested it? Have you tested it year after year over different types of portfolios, and has it worked? If you've not tested it, then what on earth are you gambling on? Because then it's a gamble. If you haven't got the data, then you've made a gamble, obviously. Okay, so I would put it in those terms. It's a slightly different format, this webinar. I hope that was okay to the usual. If you prefer the usual way, or if there's other things you like, just tell me and I'll do it in a different way. Happy to do either way for you. I will put the link up for those who might want to be on the program. There we go. Got another chat. Any other questions? This much. Oh, okay. Thank you. Ross, let me know why I won't be offended, why it's better, because that's great. You know, was it the educational part? Was it that I went at a slower pace? I don't know. Tell me why. Most things that I've done, if they're done well, it's done by accident. So let me know. If there's no other questions, I'm going to leave it at that. If there's anything I've missed, please don't be quiet. Let me know. Like today's webinar, great as well. So I'll mix it up. I'll sort of change formats and so on regularly. Was there anything that I missed? Because I don't want to have missed anything for anyone at all. Just going to check I've not, because I opened my screen for quite a lot of things, and I just want to make sure that I've covered everything. I think I have, because there's quite a lot I wanted to cover. If you're not on my public Telegram channel, we've got 4,373 people on there. You will get on Telegram, it's completely free, all the updates. So whatever's on YouTube, you'll get there, whatever blog articles I've done as well. I've also done an article on how much money you should pay for advice. And this is a good one. It's on my blog, but it's also on Telegram. I put it in multiple places. And what we did there is we said, well, what you should look at is what kind of improvement might a portfolio get. And you should be asking yourself, how quickly will you make your money back? Whatever you're paying, get an improvement in your returns. How quickly will you make the money back? And what's your return on investment, say over a 12-year period? And that's how it should be. Okay, so there's a little article on all of that, and then advisors' fees and how those fund managers sort of eat away at things, and why to be cautious. So the articles I really like the blogs, partly because I like writing them and so on, and there's quite a lot of them. We're going to restructure this as well, so we're going to put pension analysis one. So for instance, when we do one on masterclass mediocrity, Fundsmith, when we do the analysis, and you can see all these images on here, and we show you exactly how we calculated what returns they've got, so you know, and the slides so you can see them. So we do a real deep dive, a real good job on them when we go through it. Is that we'll put it on Telegram as well, so it's hard for you to miss. It's not like, oh god, I missed this, I missed that, but they're really short and sharp and to the point. And we've done it on a load of funds. I have a team now of about 10 people who help me with everything. So that's why our output, you might have noticed, has increased significantly on all of this. Okay, what percentage of portfolio would you hold as cash? Great question. So I think I forgot to show you something. Good night. Give me 1 second. And I'm going to show you an important slide. Okay, now it's just personal choice. I like to, and it's irrational. I should have 100% invested. After all, I'm an expert. Surely I should have 100% invested. So why don't I? I quite like this, looking at 10, 15% in cash. It's got nothing to do with what I think about the market. This is from Goldman Sachs Wealth Management. Okay, what you can see on screen there. And the reason I'm showing you that is to say to you that, look, that's what Goldman Sachs Wealth Management is saying. They say, and I think it's a bit conservative, that for fixed income, read cash. Okay. Oops, I'm going to move this. I don't know why that's done that. There we go. This is from Goldman's as well, I think. this is definitely from Goldman's, about how the holding periods for US institutions has gone down. It used to be you buy and hold forever in the 60s and 70s, even 80s to some extent. Now it's 12 months and you reevaluate. We know that. And this is why I tend to have 20 to 40 stocks. Okay, if you want to keep things really simple, you just do that. Third cash, a third S&P, exit on a daddy bear, third quality 5+, exit on daddy bear. But anyway, there we go. That's those as well. I'm going to check the chat to see if there's any other questions. Due to transferring pensions, I'm not in the market right now. Is now a good time to deploy a 3-figure sum? In hindsight, I'd be able to tell you what I would say to you in a nutshell is, remember, we're a bit overbought, and therefore my absolute best piece of education I'd give you in terms of what to do right now. Okay, what to do right now is 2 things. One is this: take a photo. Right, I'm here. You might be here. All right, that's one. And 2 is this: what should I do? Right, those 2 things answer the question for me. So I'm feeding to you the algorithm I use to answer the question for me. And in all my years of expertise and reading, and we got this from some academic research out of, I've forgotten the name, they're at University of California at Santa Barbara, Terence Odian. Okay, he does some amazing research on what gives greater investment returns based on behavior and outcomes. So it's not trying to gamble on the future of the market, because that's like you saying, should I put it all on red or black, Alpesh? Okay, no, what I'm saying to you is, I don't know, but in this state of the market, I would be edging in dollar cost averaging, let's put it that way, or putting tranches in, because you're not trying to be perfect. In hindsight, you won't have done the optimal thing ever. You won't have done the perfect thing. The perfect thing might have been to have bought everything yesterday at 2:23 p.m. We don't know. Okay, to get close enough. It's to get close enough. Is the market due for a 10% fall at least in the next 6 months? I already told you that. I showed you it is. In the next 6 months, there'll be at least a 10% fall. Does that mean you don't buy today? No, it just means you plan and prepare. Can you show the Daddy Bear's slide? I can take a pic, please. Yeah. Well, except, where did I put it? Where did I put it here? Yes, I did. There it is. You can take a pic. It's in one of my books. I don't want my clients to think, why did you do the Holy Grail? I mean, it isn't in this version because I haven't written a book this year, although, oh my God, I've been offered a deal by several publishers. When you get 450,000 followers on TikTok, you get that. I've also got one of these little puppies, courtesy of YouTube. They used to give big certificates. Well, they still do. There you go. Put your name up like that. It's quite good. And it says, congratulations for passing. I wish it said 1 million, but it's not 1 million. That's the next step. Followers. But anyway, we shall continue. So I'm going to go. It's 10:20. So I don't want to over. Thank you. I hear. I have your book as well. Great, Chaz. Oh, speaking of which, you just reminded me, Chaz. I better put some more stuff up. Very good point. Files. I need to share some more files with you. Okay. Hopefully you all got the Google Drive link that I sent earlier with the 2 stock reports. That's how I want you to think. I've shown you what a first-class stock report looks like. In hindsight, when you look at it now in hindsight, oh, damn, we got it wrong, because we should have said, put every single penny you've got into these 2 stocks. Don't leave anything dry and go to the bank and borrow money. So we got it wrong, because in hindsight, they both went up so much, which just goes to prove you. We didn't know they were going to do that, which is why we were cautious and said, here's a stop loss, here's this. If we were that clever, we wouldn't ever say stop losses anywhere on those stock reports, would we? Okay, so I just wanted to say, just wanted to make that point to you on that. So anyway. Now we got more chat questions, and then I'll go. Google Drive received. Thank you. Yes, Mr. File. Thank you. Excellent. Alpesh, your pie chart showing first. Did it say S&P cash quality 5? Yes, Glyn, it did. I did that for simplicity's sake. It was just to show people how you can mix things up. People get very fixated that you're either going to be all in, all out, and you've got to. That was just an example to say, look, if you want to keep it really simple, you'd have the quality 5 plus, you'd S&P and third in cash, and you might as well third in cash. That's too much. Yeah, you can tweak the pie. What I'm trying to get people to realize is their job is not to be perfect. Their job is not to pick market tops and market bottoms or read narratives or gamble on individual stocks. It's to have a resilient portfolio. It sounds boring. Don't take my word for it. I'll tell you whose word I want you to take for it, or which people. Harry Markowitz, William Sharp, Richard Thaler, Daniel Kahneman, Eugene Fama, all Nobel Prize winners, and Warren Buffett, Goldman Sachs Wealth Management's quantum division and their research on the Sortino and what I'm telling you about in terms of trends, AHL, Winton Capital, AHL is Man Group, Brevin Howard, okay, DE Shaw to some extent, in just some of the trend following stuff and the Sortinos and all of that. But you won't have heard of those. Why should you have? That's why I like sort of teaching this stuff. Okay, everyone, I'm going to get going now because it is getting a bit late. And I'm going to put my feet up, I think, which usually means doing emails. But turn the screen off. I hope that was enjoyable. I hope everybody liked that. And I hope all the files came up as well. Hopefully the files came up. Yep, as well. So that's good. For those I've not checked on the program, newly on the program, I'll send you an onboarding email after this as well. Thank you all for being on, and yeah, no, I appreciate it. And I'll try and do more of these videos as well on YouTube and more columns on that. But if anybody's got specific feedback they'd like to give me, I'd really appreciate it. Why you like this more? You can either put it in the chat because I'll get that afterwards, or drop me an email because anything which can help improve on the things that you've liked, that really helps me tons. I'm too close to I can't see the wood for the trees, okay, because I'm in this all the time. So any feedback is gold. So thank you very much, and I better get going. See you all. Bye.